We've undoubtedly seen a change in the environment since the beginning of 2026 for fixed income markets. Joining me today to discuss the changing environment and the positioning of the PSG Diversified Income Fund is Fund Manager Marc Beckenstrater. Marc, welcome.
Hi, Audrey, thanks for having me.
So, 2026 so far has certainly been a tough year for bonds, both locally and globally. Can you highlight some of the key developments we've seen since the beginning of the year?
Yes, so fixed income markets are grappling with what's called R-star, the neutral rate. They are really unsure about how one should price long-dated fixed income securities. So that is the academic concept of R-star, the neutral rate, and the term premium. How much should one get compensated for owning long-duration fixed income government bonds? Because we lived in a world of very low rates since the GFC, the market hasn't had to grapple with this and hasn't had to grapple with how much more compensation is now required to own the long-dated assets given the debt to GDP numbers, the fiscal situation in the developed market economies. So whether it is the UK or Japan or the US, we've faced a world of fixed income assets moving, having large moves when the fiscal fears rise.
And we've certainly seen long bond yields in developed markets trend up over the past year. Now, this has certainly brought to the fore that investing in bonds is not risk-free. And can you maybe highlight for us how PSG Asset Management thinks about, balancing taking risk in their portfolio with the need to achieve the long-term portfolio objectives in the fund?
So we have a very basic sort of first principle that the real yields that one observe are achievable if you buy and hold those assets. And so we started as a first principle about what is the real yield we'll get on a buy and hold basis for this asset, and then we overlay various bits and pieces on top of that. What is important in portfolio construction is that you don't put very large macro positions on the basis of some view that you have. It's much better to build a portfolio of various high real yielding assets that have different macro drivers, so no matter what the actual outcomes are, the portfolio is a much better diversified and doesn't have single driver risk.
So given the challenging environment that we are currently seeing, what do you think should fixed income investors be aware of?
They should be aware of that long-dated bonds are no longer an asset which you only have to own for insurance purposes. Long-dated bonds around the world are starting to offer decent real yields. If one looks at the 100-year history, anything above 1% real for developed market bonds is a credible investment return. We are getting today in linker markets, so TIPS in the US or inflation-linked bonds in places like South Africa or the UK, you're getting, in the developed markets, 2% real to own those assets. That is a credible return to put into a portfolio.
So Marc, given the changing environment that we've seen since the beginning of the year, can you take us through changes that have been made to the PSG Diversified Income Fund's portfolio so far, and how that fund is positioned to take advantage of the environment looking forward?
So at the back end of 2025, so Q3 and Q4 2025, we were actively reducing duration in nominal bonds because South African nominal bonds had done exceptionally well. We were rotating those into shorter term instruments and into linkers, so the South African inflation-linked bonds, as well as the shorter dated South African inflation-linked bonds. This year we have continued to invest in the short end of the curve, but we have judiciously started to reposition ourselves in longer dated nominal bonds where the returns have now improved as the bond prices have weakened and the yields have improved. We have further added to our emerging market and developed market global bonds by adding to Japanese yen-dated, long-dated bonds, UK inflation linkers, and we've added to our Brazilian bond positions. So we have been adding to duration in weak periods of the market over the last couple of months.
Marc, thank you so much for joining me today and talking about fixed income positioning in a challenging environment.
Thank you very much.